stock that was once every analyst's prized stock, and now it's fallen from its throne. Christine Mhundwa went to seek out some expert opinion on unsecured lender African Bank.
South Africa's biggest unsecured lender's plunging share price has had everybody talking, and most seem to agree on one thing.
I think they made an error in buying Ellerines. They overpaid for the assets. That's now all been written off. But the quality of the loans that came out of that channel was simply just not good enough.
Whilst Ellerines is built on the back of lending to buy furniture, what banks and furniture businesses have in common is not immediately obvious. So this looked like a huge strategic leap in which African Bank didn't have an obvious competitive advantage.
But hindsight is always a perfect science. And going forward, what should the company do to keep in the game?
Their biggest asset is their loan book, which is 60 billion. Now they've written that down to 48 billion. The question is that enough? Does that 48 billion represent money that they can collect in the future? I can't know that for certain, but certainly their last presentation that they've indicated that their environment has deteriorated, their collections have deteriorated. So to put me at ease as an investor, I would like to see them provide for their entire non-performing loan book, which is roughly in the order of about 28% of that 60 billion. So if they had to do that, then we get a true reflection of what book value really is.
The things I would concentrate on is Ellerines. What is their strategy there? Are there potential buyers? Can they get that business at least to break even? Because you know that could become a black hole where you have to pay those, where you have to fund those losses for the next couple of years because you have a huge infrastructure. There's cost that's associated with that infrastructure. There's huge leases that you can't get out of overnight.
Just over 2 years ago, in April 2012, buying an Able share would have cost you 40 Rand, giving the company a market cap of an estimated 32 billion Rand. Today, the same share is valued at 6.90 Rand, and 22 billion Rand has been wiped off its market cap, making it roughly the size of what it paid for its purchase of furniture retailer Ellerines in 2008 for 9.1 billion Rand. The jury is still out on whether or not the bank will offer a rights issue, but with the share price sitting just below 7 Rand, is now the time to buy African Bank shares.
If they're to provide for the entire non-performing loan book, the book value would drop to 4.80 Rand. That's like a liquidation value. I don't believe that African Bank has going concern risk, so I don't think the value will ever get to that. But certainly at 6.90 Rand, on a conservative book value basis, you're paying roughly 2.5 times conservative book value, which is more than what you'd be paying for a South African bank, roughly at 2 times book value. So I don't think it offers value at this stage. Buy at 5.40 Rand.
Even if this is a compelling recovery story, a excellent turnaround prospect, even if that is the case, to me this just feels like it's in speculative territory, that there's a huge amount of risk taking, and the difference between investing and speculation here I think is a yawning deficit. So in our case, we aren't exposed to African Bank, and if there were a rights issue, we wouldn't, in the absence of some dramatic change in the landscape, we wouldn't be inclined to follow a rights issue or to pursue a rights issue.
As seen here from a table extracted from the bank's website, a wider group of analysts are also split.